Time for the market report. Big moves happening this week.
That's right, Mike. Some commodities trending up in a big way, and we've got some information on farm income levels. But first, the numbers. What were last week's biggest gains and losses? And then we take a look into why pork prices are on the upswing. And finally, MSU ag economist Kevin Kim talks to us about farm income levels and what we can expect this year. So, markets closed last Friday trending down. Row crops mostly affected while livestock split. Let's take a look. Last week's biggest gain, lean hogs, up over 6 cents, an over 6% increase from the previous week. We'll get into the reasons why in just a bit. Last week's biggest loss, cotton, down a little over 5 cents, an over 5.5% decrease from the previous week. Lean hog prices rising again. We've seen this happening over the past month. 2 weeks ago, over 14%. This time, not as much, but still significant. So, why is this happening? According to market analyst Kristi Van Ahn Kjeseth, 2 reasons for this. 1, low cattle herd causing transition to pork, and now bird flu causing concern over poultry safety.
Yeah, I think you're looking at consumer sentiment. Whether or not you agree with everything that's happening with the flu, whether or not we know that, consumption, it's not going to affect consumption. But when you're hearing that story on the nightly news, some people are going to be like, I'm out. I'm not going to be buying that product for a while. We have not heard about anything for our pork. And so the general sentiment is that you could see the demand shift somewhat from beef consumption to pork consumption coming into grilling season. And I think that's helping the pork market. And so you're all looking at it and you're saying which one hasn't brought up to the subject, which one hasn't been brought into the bird flu story, and that is pork. So I think you're looking at it not only at the switch from beef to pork, but also the switch from chicken and poultry over to pork as well.
So recently the USDA released a report suggesting farm income levels may be lower this year. We reached out to Kevin Kim, ag economist at Mississippi State University, who is a specialist in this particular subject, for his insights into the reasons why and what farmers can expect.
So the USDA just released their newest forecast in February. And the current forecast is that the net farm income level, so the farm income level after considering 4 different types of costs, we expect that the net farm income level for the entire U.S. ag sector will drop by 25%, which will mark the largest drop in the recent history. But one thing to note is that despite the drop, 2023 was a great year. So the net farm income level will be still on the 20-year average or slightly higher, but the drop will be pretty significant compared to last year.
Is the decrease expected for all producers?
So sort of, but we know the current expectation is that certain producers will face larger drops. So for instance, corn and soybean producers, we expect their cash revenue to decrease between 10 to 14%. On the other hand, we expect the drop to be only about between 1 to 2% for cattle producers. For hog or poultry producers, we actually expect a somewhat steady revenue for this year. But the decrease in the revenue is only one of the factors that's going to affect the farm income level.
Yeah, other than cash receipts, what are the other factors that are going to affect this?
So the first contributing factor will be the decrease in government payments. So the current forecast is that USDA's direct payments to the agricultural producers will decrease nearly 15% this year. For Mississippi, it's a little bit trickier one because the USDA just has designated all the counties in Mississippi as a disaster area due to the droughts that we experienced in 2023. So there might be some additional packages introduced specific to Mississippi agricultural producers, but right now we do not know what's going to happen. Another factor that affects the farm income level will be the increase in the farm production expense. So even though the revenue is expected to decrease, we expect the farm production expense to increase. So we are talking about fertilizer, fuel and oil, labor, feed purchase, livestock purchase. All those expenses are expected to go up slightly this year. But I would say that the most significant increase from the expense side will be coming from the farm loan interest payment expense.
Yeah, let's get a little bit more into that farm loan interest payment expense. What exactly is that, and what makes that so special?
So this is the interest payments that farmers pay for the loans that they take. So we're talking about farm production loan interest or farmland real estate loan interest. So at the end of 2023, based on the survey of bankers, it was shown that farm loan interest rate was between 8 to 9%. This is basically a double of what we have seen about 3 to 4 years ago during COVID-19. During that time, farm loan interest rates were between 4 to 5%, and again, it basically doubled in the last couple of years.
That was part one of a two-part interview. We'll finish it next week. Dr. Kim explains how inflation, a major reason for farm loan interest rates rising. And that's it for a deeper look into the markets.